Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.
Hello and welcome to Inside Options. I'm James Boardman. This week we're focusing on the market environment. So who's out there trading and why? So we're going to look at some examples of who uses options, who uses futures, why they use them. So the main thing we're going to focus on is the difference between speculating, arbitraging, and hedging, and why you would do one of those three things. So who are the main users of derivatives? In the derivatives markets, they're the three main types of investors. So there's speculators. They want to profit from taking on additional risk. They want more risk, and they're going to get paid for taking on that risk. Hedges use derivatives to minimize or just to manage the economic risks that they're already exposed to in their business. And arbitrageurs, they try to profit from discrepancies in the pricing of different financial instruments. So let's look at hedges. A hedge is someone who has a pre-existing economic exposure to something, and they want to manage that risk, and they can use the derivatives markets to do that. So hedges are trying to create economic certainty in an uncertain world. So what they do is they'll trade a future. So they'll lock in the future price for something, and then they can be protected from unexpected price movements. This helps them to plan, budget, and create a more certain economic environment in which they can then plan and manage their risks. So a maize miller, for example, he wants to ensure that he gets the cheapest input price he can. He wants to have certainty about what he's going to be paying for mealies, so he can mill them into maize meal, turn it into a Wisa maize pup, or turn it into knickknacks by selling it on to Simba. So what he does is he buys maize on the futures market. The other thing he could do is he could buy call options. This would protect him against sudden price rises in his maize. So another example of this would be someone who was a clothing importer. So the clothing importer, she's the big buyer for, say, Truworths. She knows that she's going to be buying quite a lot of stuff in the future. She knows what she wants to buy, so she wants to hedge the uncertainty of the rand-dollar exchange rate. The issue would be that if her exchange rate was poor, she wouldn't be able to sell her clothes in South Africa at a great price. So what she could do is she could buy calls on the rand-dollar exchange rate. So she'd be able to buy the dollar at R6.90, even if the spot price went up to R7.20 when she actually did the transaction. So what she's done is she's locked in a relationship. She's locked in a level. And that's what we're trying to do with both futures and options. However, for options, there's a cost involved. You need to put in a premium. That premium will be often in, let's look at currency, it'll be quoted in cents per rand dollar. So for example, 20 cents per rand dollar, you'd get a call option and you'd be able to lock in a price. So you wouldn't ever have to pay more rands per dollar than that strike level you'd got. So by paying that premium, we can now buy dollars at the expiry of our contract. So if the price moves down to R6.50 per dollar, from when this morning I checked, I think it was about R6.75, we have no obligation to exercise our option. And thus we can benefit from that move. That move from R6.75 down to R6.50. Problem is, if we traded a future, we'd have to keep paying in margins. We'd have to pay in that 25 cents difference. So we've created certainty for cheaper if we used a future, but we lost the ability to profit if the market moved our way. So another trade that hedgers often use is called a zero cost collar. So in a zero cost collar, we are often buying a put and selling a call, or vice versa. So they'll be buying a call and selling a put. In a currency market like ours, where you're worried about the rand weakening, what you would do is you would buy a call because you're worried about the rand moving from 7 rand to 7.50, and you would sell a put because you really didn't think the rand would go beneath 6.80. So now the point of that is that the sold option pays us the same as the bought option cost us. So we enter into a transaction with a counterparty and we buy one option and we sell another option. That gives it its name of the zero cost collar. So let's say we paid 20 cents for it. We paid, let's say, a 7 rand call, 20 cents, and a 6.75 put. We got 20 cents for selling that put. Reason being, we really didn't think the price was going to go beneath 6.75, and at that level, we can do profitable business. People really like doing these trades because of that zero cost feature. Now, I'm not convinced it is always or even usually a good idea. You see, it's important to remember that often the zero cost collar can work against you. So let's say we were a clothing importer, we're worried the price would go up, we're going to ship in a new summer collection, and the payment for that is going to be due sort of beginning of October. So the dollar rand, as I said this earlier, when I checked, it was about 6.75. Now the purchase we're making in September, the clothes buyer needs to lock in that price. So he's worried, or she's worried, that if it goes up, it could go to 7.50 or 7.60. Then their clothes are going to be quite a bit more expensive than the current rand dollar rate. So what they do is they enter into a zero cost collar at 7 Rand 20. Now she's going to buy a call for 15 cents per dollar and sell a put at 6 Rand 85 for 15 cents per dollar. Now she's put in place a zero cost collar and she can sleep easily at night. However, if the dollar suddenly weakens and goes to 6 Rand 40, she would have lost 45 cents. And now she won't have the opportunity to buy the collection even cheaper. So by selling an option, you're actually selling an opportunity. You're selling an opportunity cost if the price moves the other way to what you'd expected. So in this case, she would have been better off just paying the 15 cents on the own for the call. So often, hedging will end up being an expense item on your income statement. I think people should look at that sometimes with options and accept that it's kind of like insurance premium. You really don't want your business to burn down, but you're going to take out fire insurance on it. If it does, a worst case scenario, you're going to be covered. And that's really, really a great peace of mind that you are covered, you will recoup those issues. However, that insurance premium each month, that is just a cost that you have to pay to your business, but it creates security. And that is what you want to do with options. An example of it could be sort of black swan insurance. So your business is fine up until the rand dollar hits 8 Rand. It's done that quite a few times. If the rand dollar spikes suddenly, which it can, we saw in 2008, saw it again in 2001 after September 11th, we saw it as well in 1998. Suddenly these massive spikes in the rand, all the money from the States rushes home because they're worried about conditions in the States. What you want to do is take out insurance. So something maybe extreme, like a 7 Rand 80 call, maybe you could buy that for just 5 cents. Now that would then protect you in the event of these huge moves that you can't control. The other thing you can do with hedging is you can look at economic risks. With the economic hedge, where you have business in the States, so if you do some business in the States where you're buying and some business where you're selling, you've got a natural hedge in place. That's the best kind of hedge you can have because it doesn't actually cost you anything. It's internal to the business. So anyway, that's a little bit about hedging. We'll be right back after a short break.